Good morning, traders. It is Friday, January the 8th. Taking a look at the charts, I'm going to kind of recap on a interview that I did with Jim Godart yesterday. And just kind of recap on I want to give you a visual of where we're at. Now, overall, this is the TSX, the Toronto Stock Exchange. It's heavily weighted with commodities, and obviously commodities have been underperforming for several years. And in 2014, 2015, we saw more or less a double top form in the TSX. And then, of course, we had a breakdown halfway through last year, putting the Toronto Stock Exchange into a bear market where it broke down, had a rebound up for its last kind of gasp of air before it started to move to these new lows. Now, overall, we're starting to get oversold. In the index, we might fall a little bit more here, but overall, we've already kind of now had this first kind of bearish move, and we've made a lower low, and we're likely going to see it come back up and have some type of bounce, and it'll continue to probably grind lower for several months until the US stock market puts in a bottom. Now, if we take a look at the US side of things, let's take a look at the IYT, which is the Transportation Index. This index broke down midway through, or 2/3 through 2015. We had this critical kind of support area. Price came down, broke that level, and then we saw it kind of bounce up, and it never broke any higher highs from a previous high. It made a lower low, a lower high, and then of course it broke down. It's starting its first kind of bearish leg to the downside. So overall, we're starting to get oversold in the market here. We might see it drop down a little bit more, but overall, we'll be looking for some type of bounce again before it goes into its kind of full-out bear market and pick up speed. And you can see the last major area down here. This is likely where we'll find some support around the 95 area or the 90 area. So there's a long ways to go for the transportation index to continue to fall. Now, if we go and look at the broad market for the US, looking at the Russell 2000, it's the next to follow usually after the transportation index. And of course, looking at this chart, you can see we've got a pretty critical support zone right across here, right across this low here. Let me just get a little bit lower. Right across this area. We're about 2.5%, 3% away from breaking this potential neckline. You could argue here we got a head and shoulders formation. And of course, if we break this level, then we are getting oversold. I wouldn't be surprised if we maybe pierce this level, but then have some type of bounce back up for the bear market to really kind of start heading lower and picking up speed. And of course, you can see the last consolidation here back in 2011, 2012, and downside kind of target is somewhere around the 75, 80 mark where we'll find some high volume support. So there's lots of room again for the Russell 2000 to break down and fall, and it has yet to break down, but it's got a very bearish pattern here, a topping pattern, and it's more mature than the broad market, the SP 500. Now, if we take a look at the SP 500, it's still, SP 500 is still a long ways away from breaking this this neckline across here. We're still several percentage points away. And of course, the Dow and the SP 500 are what most investors follow. They don't follow the Russell 2000 or the leading stocks. So it looks as though we're just having a pullback, and you know, this might consolidate up here. Large caps can hold up for a while. They're kind of the safe haven play. During times of weakness, you don't want to get into speculative stocks. So this could still hold up and grind for a while before we have like the initial breakdown and then eventually see it move down. And of course, it's a long ways to fall for the SP 500 down to the 130 mark from right now. It's at pretty much the 200, 195 mark. So a long way to fall for the market before it hits its first major support zone. Now, if we take a look, let's just zoom in on the time frame a bit here. Zoom in a little bit more. Now we've seen, just look at the recent couple bars here, we've seen more or less 6-7 down days of selling in the stock market. And if we take a look at gold, we've had 6-7 days of a pop here, 5 or 6 days of a pop. So money's been moving out of stocks. We've seen a little bit of pop in gold as a safe haven play. And we talked about this in a video just the other day, how we had this short-term basing pattern that if we were to break above this pivot high, which this is a W formation, then there's potential for it to pop the depth of this. So whatever this move is, we move that to the upside. It's got potential to move somewhere up to this area. That'll be a reaction high. It also happens to be just right through all this noise from this from here to here, we've had a lot of chatter right through here. So the average price through there, that is where we'll probably find some resistance. Now gold is trading down today, stocks are trading up. They're pretty much trading inverse to each other right now. And the grand scheme of things though, if you look way out in gold, it's the same for gold miners and gold stocks. It's nothing but a series of lower highs and lower lows, and all we're having is one of these little pops, just like we've seen in the past, another pop, and they get sold off, might move up to another kind of ABC correction high before we get another major leg down. But overall, no signs of a bottom in the gold and silver market yet. We're just not even really close to it until we see a strong impulse wave. We need to see an impulse wave where we see a move where we see the market move up. It has to break usually two significant highs, so that I'd consider this a significant high, and this here would be the previous kind of significant high, so right here. So we need to see a move above those, and then the first consolidation or pause can be bought, because that could be the launch pad for the second half of the move that would break it eventually out of a much larger formation, and we could see it really take off. So we're a long ways away from that happening price-wise, and probably time-wise, we're probably still months away from gold and silver putting in confirming that a bottom is in. Now taking a look at energies, crude oil continues to be under pressure. It's had a little bit of a bounce this morning, but overall, I think we're going to continue to see it trade under pressure. We're seeing a little bit of volatility, and we've made what happens is usually you see a push down, you break a previous low, and then you see a bounce, and then you'll see a push down, you'll break a previous low, kind of flush the market out, and you get a bounce. And same over here. This one was a little more exaggerated. We did play this bounce here using an ETF, the energy ETF, and got out. Now we're pushing down to a new low, and we'll probably struggle down here for a bit, and we'll probably see some type of pop. But overall, we've got kind of a downward pattern here. It's getting squished in this falling channel, and when it breaks out of this channel, there could be some good opportunity to the upside as an early opportunity to get in. But right now, crude oil is trading kind of in the middle of its downward channel, and it's oversold. Don't really want to buy it because it's in a downtrend, and it's pretty oversold still in the grand scheme of things, and there's room for it to fall. So we're just not going to do anything with crude oil at this point. Anyways, that's really it for this morning. Oh, a couple other things I wanted to touch on. Let's take a look at Apple. The darlings, Apple and Tesla, they have obviously been, everyone's been buying shares and trading it for years, and we are getting to the point here where any of these big corrections in these stocks have been bought right back up. So anybody trading these stocks, even if they kept buying and doubling down, tripling down, eventually they made all their money back and a lot more. But the thing is, the stock market was in a full-fledged bull market during this time, so that was okay. Now we are in a bear market in the stock market, or entering a bear market. These dips are going to sell down. They'll be muted, any bounce that we get, and they're going to continue to go down. So long term, I don't think you can just buy and hold Apple or Tesla. They're really kind of setting up for a much bigger move that's going to wipe out all the money that people have made trading it to the upside. Pretty much going to give it all back, because they're going to keep buying these dips, and the dips just keep falling, and you never get a recovery in price. Now at Christmas time, I was sitting around the pool with some friends, and we were looking right at Apple. They were wondering about Apple, and I said, well, it looks as though it's got a major topping formation. The broad market looks like it's topping. It's already, some sectors have broken down, and Apple has already put in a 1, 2, 3 surges. You could argue maybe even 4, but more or less a triple top, where we've had significant pop with a significant decline. These sharp spikes in price back down. We've had a triple top in Apple, huge break to the downside, breaking a previous pivot low. We've had a reaction high up into resistance, and then I was saying how it looks like it's going to be lights out for Apple, and we could see it fall significantly. And if we just zoom out on the chart here, you can get a good feel for it. Come on, server, let's load here. Here we go. So Apple, I've got a potential downside for Apple here somewhere around, I've got around the $68 to $70 level that I think we could see Apple fall down to. So you can see it's a long way from where we are. At Christmas time, we're at 120, potential all the way down to the 70. So we're talking a $50 move in Apple. and we're already down about $25 a share, so there's still quite a bit more room for it to fall. Now, Apple's already started this move. If we take a look at Tesla, Tesla has a very large pattern here. It is yet to really break down. It's forming, you could argue here that we've got a head and shoulders formation. We've got a neckline across here. We've got this these big waves of selling here. The market, you can notice it's very choppy in here. It's not like these momentum plays where you have these big massive moves and strong runs to the upside and then a sharp correction and massive run to the upside, sharp correction. Things are starting to get choppy and grinding themselves around. So this it's not a momentum play anymore. It's more in distribution phase. And we've had a couple big bouts of selling, huge drop there, massive drop there. We're forming this bear flag right here, which points to a lower side of the target, moving back down to test this critical support zone or this neckline. If this neckline is broken, then I think we're going to see this previous low over here get pierced, which would more or less, you can take this high to the low, flip it to the downside, and we're looking somewhere probably around the 100 mark for Tesla, and who knows, it could even slide with a capitulation sell-off. This type of price action right here, this could be negated very quickly. So if price gets down here, we could see a massive washout and drop to kind of this major level here where it naturally gapped and broke and took off. So these two big plays that everybody's been buying and trading and holding, investing long term, I think they might be done for 2016. Could be a very bearish year. And that's kind of my insight for now. Take care. Bye-bye.